What's going on, everybody? My name is Reda, and today's video we're going to talk about shorts, right? We're going to explain what a short squeeze is, how you can make money shorting a stock, and just kind of explain what's been going on in the recent market news. So, what is a short position? So you have a long position. That's where you're for the company going higher. You're betting with the company. A short position is the exact opposite of a long position. So if in a short position, you're purchasing, let's say, you purchase 1,000 shares of GameStop, and you think GameStop is going to go from where it's $90 all the way to like, I don't know, 5,000, right? So you buy a long position in GameStop. With a short position, you buy negative shares in GameStop. So you go to your broker and you're like, hey, I'm betting against GameStop. I would like for you guys to buy 1,000 shares. Right? I would like for you guys to buy 1,000 shares at the market price and then give them to me for a certain margin fee, right? Let me take a negative stake in GameStop so that if GameStop goes down, I make money, right? If it goes up, then I will eat the loss, and then you guys, you'll get your margin. So the broker gets these shares for you to borrow. Now you have negative 1,000 shares in GameStop, and obviously you make money if GameStop goes down. This is a typical short position. This is the legal way to make a short. All shorts are always backed by shares, right? There's also a atypical version of a short. It's actually illegal. It's called a naked short. That's where your broker just tells you, okay, you're negative 1,000 shares at GameStop. Like, don't worry about where the shorts are coming from. That's a negative short position, and it's not very typical, but I think it's good to know. It's good to know that sometimes it happens. It's an illegal practice, okay? So what's a short squeeze, right? So we understand what a short position is. What's a short squeeze? Well, let's go back to the long example. If you buy GameStop at $90 and you think it's going to go to 5,000, but all of a sudden it comes down a little bit. It goes to 85, then it goes to 80, and then it goes to 75. You get the psychology is you get scared the more and more it comes down. So at some point, people start scrambling and getting out, and this creates a massive dump. A short squeeze is the opposite of that, right? A short squeeze is, I think we're all of us shorts are short GameStop, right? But GameStop just keeps going up, and you start scrambling, you start losing your mind, so you got to buy back those shares, okay? So because you're negative 5,000 shares of GameStop or 1,000 shares of GameStop, you got to go in, you got to buy 1,000 shares at market value, right? And so you can pay back your broker for the shares that you borrowed. And this causes a chain reaction and makes the stock price go higher and higher and higher. So it's the same like how we have panic selling. You can consider this like panic buying, right? So that's what a short squeeze actually is. So let's talk about GameStop, right? So how the fuck does GameStop go from $20 all the way up to $160, right? What is this short squeeze stuff that I'm hearing about on the internet? What's going on here? So here's the biggest reason why something like this can happen. When companies disclose their short position, so let's say you're a big hedge fund and you disclose that you have a massive short position in GameStop, right? In GameStop's case, it was a company, just in general, let's say, there was a forum on the internet called WallstreetBets. WallstreetBets is a forum where people kind of just share their ideas about investment or whatever. They just share. It's typically where people show like massive losses or massive gains, like or on gambling in the stock market, right? So WallstreetBets comes up with this idea with like, hey, we have 2 million subscribers now. Why don't we just target the companies with the most short interest and see if we can, like, if our buying power is enough to push the stock price up, so that then these short companies have to scramble to buy them back because they're losing too much money. So they figure out that GameStop has a very large short float, a lot of short interest. So there is a good amount of money being held up short in GameStop. So they decide to band together and buy a bunch of GameStop, and this pushes the price higher. Okay, so the price goes higher and higher and higher. Some companies that are short GameStop, they're like, fuck it, it's not worth our time anymore. We're going to leave GameStop, right? So they go back and buy those shares at market, and the price goes a little bit higher. Now, that's a typical short squeeze. The thing about GameStop, and we're going to talk about a few more examples here. The thing about GameStop was the push on GameStop was so rapid and fast that while other companies were scrambling to get out of their short position, it keeps going up higher and higher and higher and higher. Let's say as it goes from 10 to 20, then it goes from 20 to 30 or 20 to 40. Now the market makers, if you have any issue understanding market makers or anything like that, I'll have a note for my video on market makers. It'll show up like somewhere on the top. the market makers issue new strikes for calls on GameStop, right? So because WallstreetBets is primarily an options community, while the idea of, hey, we're going to buy a shit ton of GameStop is circulating, people are also buying a lot of calls on GameStop. So the market makers issue new strikes because GameStop is going up and up and up, and typically these guys, they're trying to gamble with options, so they're buying far out of the money strikes. So GameStop is going higher and higher and higher, so they issue new far out of the money strikes, right? I hope that makes sense. They issue newer out of the money strikes. So let's say the highest strike when GameStop was at 15 was 50. Now GameStop's at 40, so they issue strikes all the way to 80 calls, 90 calls. This causes, because they're issuing these calls, remember the market makers need to stay delta neutral. Again, if you have any questions about that, watch my video up there. The market makers need to stay delta neutral, so they actually have to buy those shares before they issue these calls. So this causes even a higher push. So now it's at, like, GameStop is at $50, for example, and GameStop is at $50, for example, and now they're issuing more calls, they're issuing more strikes, they got to buy those shares to buy those strikes, and it's a chain reaction. Shorts are getting squeezed, strikes are being issued higher and higher and higher and higher and higher, and we just keep going and going and going, right? Here's the deal, though. Primarily, the issue was obviously that these companies had disclosed their shorts, and that short information is kind of readily available. That's really the first domino. The second domino is the first people that left their short position. The third domino is the out-of-the-money strikes being issued. And the fourth domino is just the fact that the WallstreetBets community was pushing the stock so hard, like, hey, don't sell, buy more equity, buy more out-the-money options, and this creates a chain reaction. The squeeze just goes nuts. Now, they obviously didn't just target GameStop. BlackBerry and AMC are two other companies that got targeted, right? I'll just go over here really quickly. We'll put BlackBerry up here, and you'll see that even BlackBerry just had this massive. We'll go to a chart that's easier to view. This massive short squeeze all the way from $4 to $20. So a good example here is like, okay, so you're taking a look where we are right now. You're like, okay, BlackBerry's at $5. So they push it all the way up to $7, and shorts start. We'll start over here, so it'll be easier. BlackBerry's at $6.50. They push it all the way up, and shorts start squeezing, and it goes all the way from $7.50 to $9 in one candle because shorts are leading. They got to buy back their positions at market price, right? Then market makers issue new shares. Let's say that issue new strikes. Let's say at $7, the highest strike was 15. So they start issuing 20s and 18s maybe, or 19s or whatever, right? They start issuing higher strikes. And this causes the price to surge even higher because the market makers got to buy the shares in order to issue new strikes, and then it creates this chain reaction, which is this big, massive short squeeze. That's pretty much the gist of what a short squeeze is and how shorts can lead to this massive reaction. Think of it as the opposite of panic selling, right? So the question is now, Reda, how come we're not all doing this? We can make a shit ton of money. Well, it's because this is not a new strategy. Shorting is not a new strategy. Shorting stocks isn't this brand new thing. These kind of short squeezes happen all the time, at least a couple times a year. And a really good example of this is I'll put this in there. Tilray, right? So this is a cannabis company, and you can see all the way back in the day, it went from 25 up to 300. This is when the company just recently IPO'd, and there were a lot of people shorting it because it was this taboo kind of cannabis company, and people noticed that, so they pushed the stock price up, caused market makers to issue shares, or issue strikes. With those strikes, they got to buy more shares, and it creates this massive short squeeze, right? But in the end, it always came back to reality, right? So although it went through this 1 month pump, it always comes back to reality, right? And it ended up even going all the way from, so it came out at $25. It had a low of $2.50, right? It looks like just not too long after, right? So that's the idea behind this. Is yes, short squeezes are a strategy that are not a brand new thing. Yes, they cause these massive moves in stocks, but they're not something that's you can't rely on it, because first of all, you got to be very quick to act, right? Not a lot of people are going to make money. Most people are going to hold it even after it dumps, and because there's just not a lot of experience, and the people who are trading this aren't very experienced, it creates an environment where it's kind of hard to make money just in general, right? You're buying too late, maybe you're holding too long, or you think you can't lose, or you bought, whatever. So essentially, you're listening to all these gamblers on WallstreetBets. So yes, it theoretically, if you could get everybody to do one thing, it would work, but it's very hard to do that for very long periods of time. So it just creates this kind of big short squeeze, and then it just tapers off, and we go back to reality. So that was my little quick explanation on short squeezes. I'm sure it's not perfect. I'm sure that some people might have some questions. If you do have questions, remember, I'm not your doctor, your certified financial advisor, but leave those in the description below, and I'll try to get to most of them, or actually all of them. And I see you guys in the next video.